Welcome to the Deep Dive, where we break down the latest earnings calls so you don't have to. Today, we're digging into Synchronoss Technologies, that's ticker SNCR, and their very interesting Q3 2025 earnings release.
Very interesting is a good way to put it. This one was a real mixed bag.
Right. I mean, Synchronoss, for anyone new to them, they do these high-margin cloud solutions for big telecom carriers. And this quarter, it really felt like a story of two different companies.
It did. On one hand, you have this massive beat on profitability and some really smart moves on the balance sheet. But on the other hand, that top-line revenue number was a bit of a problem.
The classic growth versus cash flow dilemma. So let's just jump right into the numbers. Give us the headlines that hit the tape.
Okay, so the headline that probably made everyone's jaw drop was the GAAP EPS. It came in at 51 cents.
51 cents. The consensus was what, 15?
Exactly, a colossal beat. Even the non-GAAP number was strong at 63 cents. So from a pure profitability standpoint, they knocked it out of the park.
So if the earnings were that good, why did the stock get a tiny bump after hours and then just, fall flat the next day?
Because the street looks past the headline EPS and straight to the growth story. And that's where things got tricky. Revenue came in at $42 million.
Which was a miss.
A miss of about $1.2 million against consensus. And more importantly, it was down 2.2% year over year.
Ah, there it is.
That's it. Investors saw the earnings beat, but then they saw the guidance cut that came with it, and all that optimism just evaporated.
Okay, so management knew this. Their whole narrative on the call seemed to be, hey, forget the top line for a second. Look at how we've cleaned up the business. They really framed it as a profitability and free cash flow win.
And to be fair, they have a point. Operationally, this is a tight ship. Recurring revenue is now almost 94% of their total revenue. That's incredibly stable.
And the margins are still there.
Oh, yeah. Adjusted gross margin is still sitting at a very healthy 79.5%. I mean, this tells you the core business model is strong. It's a sticky, high-margin SaaS platform. They just need to sell more of it.
Okay, let's go back to that huge 51-cent EPS beat. A surprise that big can't just be from, cutting office expenses. What was the real driver there?
It was a mix of things. You had some good, sustainable cost control, with operating expenses down about 3.5%. But the big kahuna here was a one-time event.
I figured.
Yeah, the net income number got a massive $5.2 million boost from a non-cash interest income event. It was all tied to that CARES Act tax refund they finally received.
Wait, a $5.2 million paper gain? So the quality of that earnings beat isn't quite what the headline suggests. That feeds right into the market skepticism, doesn't it?
It absolutely does. The market is smart enough to filter that stuff out. But what is repeatable, and frankly way more important for the company's future, was what they did with the actual cash from that $33.9 million refund.
This is the balance sheet transformation story. I mean, for years, this stock has been weighed down by its debt. What did they do?
They moved fast and aggressively.
Yeah.
First, they did a big $200 million term loan refinancing, which pushed their debt maturities all the way out to 2029.
Okay, so they bought themselves time.
A lot of time. Then they took $25.4 million of that tax refund cash and just prepaid a chunk of the new loan at par.
That's a powerful move. But does cleaning up the balance sheet solve the growth problem? What's the bottom line here?
The bottom line is a much, much healthier company. Net debt is now down to about $140 million. And management says their net leverage is now around 2.7 times their expected adjusted EBITDA for this year.
Okay, for our listeners, what does a 2.7 times leverage ratio really tell us?
It tells you they've moved from being in a somewhat risky financial position to a very manageable one. The debt is no longer an existential threat. Plus, all of this is going to save them about $2.8 million a year in interest payments. That's real cash.
So the financial foundation is solid now. But let's get back to the front end of the business. What was causing those growth headwinds that forced the guidance cut?
It really boils down to a subscriber slowdown. Across their entire global customer base, subscriber growth was only up about 1% year over year.
Just 1%. Wow.
Yeah. And management pointed to two things. A few new customer contracts got delayed, and subscriber growth at some of their existing carriers was just weaker than they expected.
Okay, let's dig into that. The Tier 1 carriers are their lifeblood. What's the story with AT&T? I saw they mentioned positive momentum, but that penetration is still super low.
It is. It's less than 2% of AT&T's total subscriber base. Management, of course, calls this a long runway for growth.
But the skeptic would say, after all this time, why is it still only 2%?
And that's the multi-million-dollar question. It's a massive opportunity if they can crack it. But it also suggests that getting wide adoption is challenging. For the stock to work, you have to believe that penetration rate is going to start climbing.
And what about Verizon? That sounded a little more complicated with their new plan structure.
Exactly. Verizon is moving people over to their new MyPlan perk system. And that migration is causing some, near-term churn and pressure. The hope is that once it's done, the cloud product will be positioned as a premium perk and have better, more loyal subscribers. But right now, it's just painful.
Right, short-term pain for long-term gain, maybe. Now, in the middle of all this, the company is also talking up its AI innovation. Why spend money developing their own AI when they're so focused on cost control?
It's all about protecting those incredible margins. Think about it. Their gross margin is almost 80%. If they had to pay a third party for all the cool AI features like photo tagging and creating memories, that would eat directly into their profits.
So it's a build versus buy decision to protect the long-term business model.
Precisely. By building a hybrid AI model, they control the cost and can scale it. It lets them compete with the big tech clouds on features without sacrificing their margin.
Makes sense. But even with that, the headwinds were enough to force them to lower the guidance for the full year.
They had to. They trimmed the revenue range down to 169 to 172 million. It was a cut, but not a catastrophic one.
And what about the profitability guidance?
They tweaked adjusted EBITDA down a little to between 50 and 53 million. But what's really key is they maintained their free cash flow guidance of 6 to 10 million, and that's excluding the one-time tax refunds.
So the message is, we can still generate cash, even if growth is a little soft.
That's the narrative.
But the market context here is brutal. The stock is down over 44% in the last year, while the tech sector is up almost 20%. I mean, the market is screaming that it doesn't believe this story.
The skepticism is real, but the macro trend is still in their favor. The personal cloud market is expected to grow like a weed. We're talking mid-teens, maybe even mid-20s, CAGR through 2030. Telcos need these services to boost revenue per user. Synchronoss is in the right place. They just need to execute.
Okay, so what are the absolute proof points the market needs to see? What does management have to deliver?
They laid it out pretty clearly. 1, sign at least one new cloud customer before the end of this year. 2, land another big tier 1 carrier in the first half of 2026. And 3, prove that the new AI features are actually driving more signups at their existing partners.
And you see this split on Wall Street, right? You have one firm, Roth MKM, cutting their price target to $10, but the average target is still way up around $21.
That's the whole debate in a nutshell. That massive gap between the current price, below $6 and that $21 average target, that's where the opportunity and the risk lies.
All right, that brings us to our favorite segment, where we look at an outrageous but plausible trade idea.
Of course, this is not financial advice, but if you're looking at SNCR, the trade idea here is what I call the deleveraged growth bet.
Okay, unpack that.
The thesis is simple. The stock has been punished so hard, failure is basically priced in. Meanwhile, the biggest risk, the balance sheet, has been largely taken off the table. The company is now stable and cash flow positive.
So the risk has shifted from financial to purely operational. Can they sign the deals?
Exactly. So the trade is built around that catalyst, specifically that tier 1 carrier win they're targeting for the first half of 26. The idea would be to go long the stock, but you could partially finance it by selling a put option that expires just before that Q2 2026 earnings report.
So you're creating a small safety net for yourself while you wait.
You are. You're basically getting paid to wait for the catalyst. The bet is that the interest savings and the cash they have on hand give them more firepower than ever before to finally land that big fish and start closing that gap between the current stock price and those analyst targets.
So to wrap this all up, Synchronoss did a masterful job on the financial side.
Dodge her pets, less debt, a really solid foundation. But the market is impatient. It's saying, show me the growth. That's exactly it. They're demanding proof that the story is shifting from survival to acceleration. The timing and size of these next few carrier contracts will be everything.
Which leaves us with the final thought.
Yeah, leave you with this. The personal cloud market is projected to grow at a blistering pace. The stock is already pricing in a lot of disappointment. So how much upside is there if the company actually delivers on just half of the new deals management is guiding for over the next year? The table is set. It's all about execution now.